Hello, everyone. Good evening. Tonight, we are going to talk about one of the most popular topics of managerial accounting. This is probably the most popular topic of managerial accounting, management accounting, or cost accounting, whatever you call it. This is cost, volume, profit relationships, or in short, it's break-even analysis, discussion of break-even point, calculation of break-even point, and computation of many other issues and numbers surrounding the break-even point. So this is one of the most important tools offered by management accounting. I can tell you that management accounting is fun. And why management accounting is fun? Because management accounting gives you a sense of reality. Management accounting is actually accounting in action. I told you that one of my colleagues in New Zealand used to say that the real accounting is management accounting or managerial accounting. Anyway, so what you see in managerial accounting is many applied tools. It has created and has offered a range of tools that managers can use. So we use accounting information, we use businesses, financial, sometimes non-financial, sometimes past, sometimes future, sometimes forecast information to plan and implement a lot of strategic decisions, short-term as well as strategic decisions. And one of the tools, or one of the most popular tools and one of the most useful tools, is this CVP relationships, cost, volume, and profit relationships. Some other ones are like relevant costs, marginal costing, variance analysis, budgeting, and quite a few. And I'll come and talk about those. Activity-based costing is one. So we have seen in the past couple of videos, we have seen some of the technical topics, technical aspects of cost accounting, like job costing and process costing in particular. So if you ask me which one is the most unpopular topic of managerial accounting, I'll probably say either process costing or byproduct and joint product costing. But if you look at the brighter side of managerial accounting, or the fun side of managerial accounting, then this is the beginning of having fun. CVP relationships will be followed by, as I said, marginal costing, relevant costs and special decisions, budgeting, cash budget in particular, and variance analysis and responsibility accounting, and also management control, other management control tools, performance evaluation, even EVA, economic value added, which is although a finance concept, but used and taught in managerial accounting. Then activity-based costing, balanced budget, not balanced budget, which is the balanced scorecard, BSC. So those two more recent ones, balanced scorecard and activity-based costing. These two are some of the new inventions of managerial accounting. Apart from that, I think, as I said, performance evaluation, and sometimes in managerial accounting, we teach capital budgeting, we teach performance evaluation, as I said. So a whole host of things. And we're going to have a lot of fun in this course. I am sure that you will enjoy tonight's session. You'll enjoy this topic. You'll enjoy these calculations for a number of reasons. One is you would be able to relate it to your personal lives, to your business lives, to where you work, to where you live, to what you see around America. So it's a privilege. As I said, it's a very popular topic. It's actually professor's dream, I tell you. Every professor wants to teach cost, volume, profit relationships. Everyone wants to teach break-even point. So it's a privilege for me to be able to teach it, and to teach it in one of the best places in the world, that is the United States of America, and to my audience of Accounting 219, Managerial Accounting at Alabama A&M University. All right, so let's start. This is my problem tonight. You can see my problem is, I said, how many iPhones or how many cell phones to bring to make my trip worthwhile? So the plan is that, let's say I go to my native Bangladesh, and on my way, I'm allowed to take some iPhones. I'm allowed to take, we've seen that when iPhone 4, not even iPhone 6 or iPhone 11, when iPhone 4 was launched, then many Chinese students, and I used to live in San Francisco at the time, many Chinese students would form lines in front of Apple stores to buy as many cell phones as possible, and then immediately take them or ship them to actually physically carry them to China, because on each one of them they would be able to make, I think they were able to make about $300. So iPhones used to be 750 to 950 at the time, and then you could buy it at 750 and immediately sell it for more than $1,000 in China, and only taking advantage of just a few weeks of launching difference, because the China launch, iPhone launch in China was delayed by just a few weeks, and you know, just using the economic or finance concept of arbitrage, you could buy at one place at one price, and when there are these price restrictions or supply restrictions, this was a temporary restriction though, just a matter of a few weeks, but you could buy them at $750 from open market and then sell it in China for more than $1,000. So if you took only 3, then that pays for your airfare. All right, so let's say I do the same, and my problem is to find out how many do I need to bring to make my trip free, cost neutral. All right, so that is our problem tonight. And this is in chapter 5 of Garrison, Noreen, and Brewer textbook, the 17th edition that I'm really proud of. So the primary purpose, at the beginning of the chapter, you'd see that there is a discussion of the primary purpose of CVP relationship analysis or CVP analysis. And the primary purpose include the following: is to examine, to estimate how profits are affected. How profits are affected by changes, by the following 5: by selling price or changes in selling price, sales volume or changes in that, unit variable cost or changes in that, total fixed cost or changes in that, and sales mix or changes in that. So how profit is affected by any one or a combination of these 5 factors. We know that profit is a function of course, selling price and units sold. So that's my revenue. And profit is a function of what? Profit is a function of your revenue and costs. Revenues minus expenses is profit. So what does my revenue come from? Revenue is a function of selling price and volume sold or units sold. So if I sell more, of course, my selling price is going to be higher, my revenue is going to be higher. If I sell less, my revenue or my profit is going to be lower. So based on my sales price and sales volume, I'm going to find my revenue, and then I have to subtract my cost. So let's assume that the only cost is my buying, is the cost of buying those cell phones, as in the cell phone example, the cost of buying cell phones from an Apple store in San Francisco. And they used to be, I think, I don't remember those, that might be, they used to be on the 4th Street or, whatever it was. Anyway, so you buy them from San Francisco and take them to, say, Beijing. And the other cost, which would be a fixed cost, is your airfare, because that is fixed. That doesn't depend on how many phones you take or what you take with you. Every trip is expensive. Let's say $1,000 airfare. So airfare is $1,000, or airfare plus hotel accommodation or any costs associated with the trip is a total of $1,000. But so you're trying to find out how many phones do I have to take with me to make the trip cost free. All right. So we're going to estimate or examine the relationships between all this, how my profit is affected by how many units I sell, at what price I sell them, how much my fixed costs are, and what my unit variable costs is, and what sales mix I have, how many things I sell or in what proportion. So sales mix is something that we'll get to at the end of this discussion. All right. So at the beginning, I'd like to draw your attention to something that we call cost behavior. All right. Cost behavior means an examination. This is an examination of how costs behave. How costs behave in response to what? Of course, costs don't change just for the sake of change. Costs behave in a certain way. If the cost is fixed, then it doesn't change with changes in volume, of course, up to a relevant range. Remember, in one of my previous videos, I told you that in the long run, there is no fixed costs. In the long run, all costs are variable. This is an important point to remember. So our discussions in this chapter, our discussions tonight, are based on more or less short-term frame. From a short-term point of view, time frame would be short-term. That's when you will have fixed costs and variable costs. But if we think of, say, hundreds of years or decades, then maybe there will be no fixed costs. And another thing we would need to keep in mind tonight is the concept of relevant range, that fixed costs are fixed costs are fixed only up to a relevant range. They're not fixed forever. And variable cost is also fixed only up to a relevant range and for a certain volume. Because sometimes if you buy way more, if you like bulk discount, the concept of bulk discount. So if you buy a lot, then your price per unit might drop, could change because of volume discount or other trade discounts. So for the time being, let's keep those aside. Let's assume that some costs are fixed for the time being and for a relevant range for up to a certain number of units. And then some costs are variable as they vary with changes in numbers, changes in number of units. So in other words, if I buy more, I pay more. But fixed costs, I don't pay any more up to a certain range, no matter how many I buy. Let's say I go out on a shopping trip. So I call Uber and I spend $13 of taxi fare to go to Walmart, and then another $13 to come back. So my total trip cost is $26. Now, this is going to be $26 no matter how much time I spend at Walmart and no matter how many things I buy. Again, up to a certain range, because the Uber driver is going to have a capacity. I cannot just buy tons of materials from that would be a truckload and then expect to bring them home by spending just $13. Also, I cannot, we say that Uber is going to be $13 no matter how many passengers accompany you. But of course, there will be a certain range, including the driver. If you hire, say, 7-seater, so there will be 7 people at most, or in sedans, there will be 5 people. So that means if you're the only one who travels, you pay $13. If you have a companion, or 2 or 3, then you still pay $13. So that's why the transportation cost on that shopping trip is going to be a fixed cost. All right. So look at this graph. This is a CVP graph. We have in the vertical axis, we have dollars, and the horizontal axis is represented by quantity. So this is number of units, quantity, and this is, of course, 0. Our revenue or costs are 0, so everything expressed in dollars. This represents both revenue and costs on one column. On one axis, there is the vertical axis, dollars, costs, and revenue, and then these are the units on the horizontal axis. So take a look here, carefully see that we have this line, we call it TFC line, total fixed costs. That means no matter how many quantity, you can see at 0, it's say it's $500. At 1, 2, 3, 4, up to this, it is still a straight line. So it's not just straight, it is parallel to the base, parallel to the base. So no matter how many units you buy or how many units you produce, your fixed costs are the same. Your fixed costs are constant. Total fixed cost is constant. All right. Then we have this line starting from, it could originate from the origin, but now I'm superimposing it on the TFC line. So starting from the total fixed cost, then we have the variable cost per unit. Now, variable cost at 0 means when the quantity is 0, when you don't have any activity, when the activity level is 0, then variable cost is 0, isn't it? So variable cost per unit or total variable cost, everything is 0 because there is no activity. Now, if you start producing, then look at the linear nature of the TVC line. This is the total variable cost line. It means with increase in volume, as the Q moves towards your right, the TVC line keeps going up diagonally towards your top right hand corner. Can you see? Top right hand corner. So it's diagonal line, it's linear, it's straight, but it has a slope. You see, it's not parallel to the base, it is sloping upward. So it's also a straight line, but it has a slope, a positive slope. It means as Q goes up, total variable cost goes up. But unit variable cost. Unit variable cost does not change. It is constant. And the fact that it is constant is known from the slope. You can see the slope is the same all the way through. The slope is the same. That means with every increment, with every 1 unit, additional unit you buy or manufacture, the additional amount of variable cost you pay is the same. So if it's $3 for every unit, then for every, like hamburger, let's say 1 hamburger is $3. So if you buy 2, it's $6. If you buy 3, it's $9, ignoring any bulk discount. All right. So it is variable cost. You don't buy any, you pay $0. You buy 1, you pay $3. You buy 2, you pay $6. You buy 100, you pay $300. Like when you go and buy gas, what happens? If 1 gallon is $2, then you buy 1 gallon, you pay $2. You buy 10 gallons, you pay $20. So it is a variable cost. Variable means it varies with increases or with changes in volume, changes in the order size. All right. So that's our total cost. Now we call it total cost because it's imposed on the total fixed cost. So if you look at it from the baseline, then it actually represents the total cost. But the line itself is a variable cost line. It is a variable cost line. So let me draw one rather to show you from the base. If we started from the base, then it would look like this. Okay, it would look like so. Now I've drawn the variable cost line from the base, from 0. You can see now if there is no activity, no cost, but as the activity level grows, the cost grows. But now these two lines, have you noticed these two lines are actually parallel lines? These two lines are parallel lines because here the only difference between this TC line, total cost line, and total variable cost line is the total fixed cost, meaning the total cost is equal to total fixed cost plus total variable cost. So saying the total fixed cost is the same all the way through, then the only slope we have is for the variable cost. Therefore, the slope of the TVC line is the same as the slope of the TC line, total cost line. So you can see it here. Now we have seen so far the total fixed cost, total variable cost, and the total cost lines. All right. Now the fourth line that we have here is the total revenue line. You can see slightly steeper, but also a linear line. It means if there is no sales, then there is zero revenue, no sales. But if you keep selling more with every unit, you get more revenue. So the total revenue line is a positively sloping line, and it's sloping upward towards your north right-hand corner. You can see. So as you sell more, again up to for a relevant range, and ignoring any bulk discount. Because sometimes if we sell 10 units, we get $50, but if we sell 20 units, we cannot expect to receive $100. The customer is going to expect some discount. But here, let's ignore that volume discount. All right. So the total revenue line has to have, as a for any viable business model, the total revenue line must have a steeper slope, a bigger slope than the total variable cost line. It means if you cannot cover even your variable costs, let alone fixed, then you have no business model. You don't have a viable business model. For you to have any proposition, to any viable proposition, let's say you're selling imported wine, so you bring very good wines from France and sell it in the US, and you buy a bottle for $7, you have to be able to sell it for more than $7 for any future of your business to have. If you have to sell it for $6, then no matter how many millions of bottles you bring, you are not going to see any profit ever, barring, let alone your fixed costs. All right, so we always have to assume that our unit selling price is going to be greater than unit variable cost. In other words, we have to cover our variable costs as a minimum for any business model to survive. All right, so we have the total revenue line here, and then the total cost line starting from the fixed cost here. And then you can see these two lines interact. These two lines intersect here. they're intersecting at a point, and at that point, we have total revenue and total costs to be the same. Can you see? At this point, my total cost is about this much, and my total revenue is also this much. So that means at this point, we don't have any profit. But the good news is we don't have any loss either. Okay, we don't have any profit. I haven't made any money today, but I haven't lost any money today, more importantly. So that's the point where you have the first sigh of relief. Can you see it? You have the first sigh of relief that finally I have hit a point where or when I don't lose money. My hemorrhage has stopped. So you have no profit, but no loss either. So that is called the break-even point. That's the magic point. That is called the break-even point, the point at which you do not incur any loss. All right. Now, before that, like left of that point, you can see there is this red triangle, red because your total revenue line is below the total cost line. So at every point here, at every point, you're making less money, you're even earning less revenue than the costs you incur. And that's probably primarily because of fixed costs, but that is beside the point. Remember here, our slope of the total revenue line was better, is greater than the slope of the variable cost line. So at every unit, we are making some money. That is true. Our business model was good. Our business model was viable. But for a long while, or for until now, we couldn't make any profit because of fixed costs. But let's not accuse any cost elements at this point. Let's not identify excuses. The reality is that fixed cost is a part of life. Fixed cost is actually I would say more of a compulsion, more compelling than variable costs, because variable costs could be discretionary. Like if I don't engage in that business, I have no variable costs. But what am I going to do with my fixed costs? My living costs, a place to live, something to eat, something to to function with. So you need a transport, you need internet these days, you need clothing, you need heating, you need food and medicine, stuff like that. So these are your fixed costs. Now you could say that, well, if I didn't have any fixed costs, of course, if you didn't have fixed costs, then you would be one of the luckiest people in the world, because it's because of fixed costs we have to work. Trust me, it's not because of variable costs we have to work. We don't work to cover variable costs, because variable costs would be zero. I can control it. If I don't work, if I don't sell anything, if I don't manufacture anything, then my variable costs are zero. But my revenue is zero too. You see that? If I don't work, then my work-related expenses are zero. I don't need to train myself. I don't need to go to work. I don't need to have any direct training expense or have any commuting. So my variable costs are zero. But what about my fixed costs? So every business, especially if you set up a business, then you voluntarily engage yourself in a range of fixed costs that start from inception. You don't even have to sell. You don't even have to have your doors open for fixed costs to trigger. Fixed costs are usually flotation costs, the business setting up costs, and all those costs. All right. So let's see here. So I don't miss this point that the slope of the TR line, you can see TR line was steeper than the VC line or TVC line. So we had been making more money for every unit. Still we couldn't make any profit until we hit that until we sold these many units or manufactured these many units. So at this point, we finally have our first, as I said, sigh of relief. And then if I can sell a little more, now things are rosy. Things are much better. Now for every unit, I am seeing some contribution to my profit. I'm seeing the light of the day. The dark episodes are over. Now you have the shiny episodes. So if from any revenue, any sales, any activity above or beyond the break-even point is going to bring you profits. But they're not necessarily any better than the ones that you had before. So don't think that the customers above the break-even point or the sales above the break-even point are the lucky ones. Every sale was a lucky one, because every sale brought the same amount of contribution margin. And that contribution margin first contributes towards your fixed costs. we'll introduce the concept of contribution margin in a moment. So what happens when I, like think about my cell phone example. If I bring a cell phone to China, I sell it for $1,000, but my cost was $750. So for every unit, I'm making $250. Use the say the wine example. If I buy a bottle for $7 and sell it for $10 in the US, then I'm making $3 for every bottle. But the trouble is, I had $10,000 of fixed costs per year or per month. So I had to sell thousands of bottles of wine to even break even, to defray my fixed costs, my airfare, my shipping, my taxes, my rent, my administrative costs, my selling and distribution costs, my financing costs, and all those. So there where this overhead, the concept of overhead that I talked in job order costing and process costing videos. So those overheads are actually the main sources of fixed costs. I told you that overhead is treacherous. If you can manage overhead, if you can rein in on overhead, if you can hold the bridle of overhead, then you succeed much better. You succeed in your business. All right. So coming back here, now the profit is rising, and if sky's the limit. So if we think that this is a relevant range, then for up to this point, our profit is going to be linearly higher, proportionately higher. So below break-even point, we have loss. And how much is our loss? The difference between TR and TC at every point. So the most loss, of course, is when you don't do anything. And that's not how much we lose. We lose all our fixed costs. And then if we start working, then we still lose, but it's still less and less and less. Let's say my fixed cost per month is $1,000, and then I'm unemployed. So of course I lose $1,000 every month. Then I start working, and let's say I sell something for $300, which I buy for $200. So I'm making only $100 of profit, but still better than not doing anything, because I'd still lose every month, but I'm not going to lose $1,000 from now on. I used to lose $1,000 every month, but now that I'm doing something, I'll be losing only $900. Then if I double my activity, if I now sell, say, $600, which I buy for $400, then I'm making a profit of $200. So that $200 goes to contribute to my fixed costs. So then in my second month, my net loss is only $800. So if I keep increasing my volume of activity, if I keep working more or keep selling more, then there will be a point when I'd be making $1,000 of profit. So $1,000 profit pays for all my fixed costs. So I'm now loss free. I don't lose any money, but I don't gain any money. I don't save anything. That's fine. But I can support myself. I can support my business. I can pay for the thing that I buy, that I sell, because I have to buy them for $400 to sell it for $600, or buy them for $2 to sell it for $3. But I'm not only making payments for my purchases or paying my bills, but I'm also deferring all my fixed costs of running the business, or even fixed personal costs. All right, so this is our important guide throughout this evening. You can see there's some algebra here. One is TR is a function of quantity. Total revenue is a function of quantity. It means, see, it's a direct function. It means if Q is 0, then TR is also 0. Assume this. So TR is a function of quantity. If Q goes up, if Q is positive, then total revenue is positive. Then look at TC. TC is equal to total fixed cost. So there's the alpha, there's the constant or intercept of the equation. Total cost has a constant element plus total variable cost. Total variable cost is not constant. Total variable cost is a function of unit variable cost and quantity. So if quantity is 0, then total variable cost is also 0. The whole thing would collapse. But this culprit will not collapse, will not be 0, even if I don't do anything. If you retire, your fixed costs are still going to be there. Okay? If you shut down a business, if you shut down your fixed costs will be there. And then, therefore, the break-even point is where these two are the same. Total revenue and total cost are the same. That means you have to have a Q, the level of Q at which the profit is equal to fixed cost, or net profit is 0. Well, not profit, your contribution margin is equal to fixed costs. All right, so we'll get to that soon. talked about our purpose. Okay, now let's look at the important concepts. I hope you are not tired yet, or not tired already. So these are important concepts, many of which I have already touched upon. The first one is contribution margin. Contribution margin is what I'm going to explain soon. But in a word, contribution margin is the difference between sales and variable costs. So at a unit level, it is the difference between unit selling price and unit variable cost. Okay, so if you qualify the words contribution margin by unit, if you call it unit contribution margin, then it will be unit selling price minus unit variable costs. If you drop the word unit, if you just say contribution margin, then at any level, contribution margin is sales minus variable costs, or revenue minus variable costs. And then the contribution margin ratio, that's also another concept that we're going to bring in. I have formulas for that. So contribution margin ratio is that contribution margin divided by sales. So you first calculate the contribution margin, which is the difference between sales and variable costs. So you have sales, let's say $10 of sales, and variable cost of $7. Or in our iPhone example, our selling price is $1,000, buying price is $750. So our contribution margin is $250. So that $250 divided by selling price of $1,000. Or in my wine example, so I buy wine from France for $7, sell it in San Francisco or in Alabama for Huntsville for $10. So I make $3 of contribution margin. See, the contribution margin is very close to gross profit. Very close, but not exactly, not identical. So it's the difference between selling price and your variable costs. And because we are considering merchandise examples, like I buy, I'm not using manufacturing examples yet. So if you buy and sell like a merchandiser, then of course your buying price is the main variable cost. You have to buy to sell, won't you? You have to buy to sell in order to sell. So I'm buying French wine for $7 and then selling them for $10. So my margin is $3. So that 3 divided by 10 is my contribution margin ratio, CMR. Then you have the break-even point, the point at which we don't make any profit or lose anything. We'll look at the formulas later. And the total fixed cost, unit variable cost. See, for fixed costs, we don't use unit fixed costs at all throughout the chapter. So fixed cost, and occasionally you're going to just say fixed costs, then assume it to be synonymous to total fixed costs. So I try to be careful in not dropping the word total, because in many places we have units, so that people can differentiate and can keep it clear in their minds. So I use the total whenever I call fixed costs. So total fixed cost, and then we have unit variable cost, and we don't use total variable cost, almost never, except in that graph. So we are going to use total fixed cost and unit variable costs. So if we just use fixed cost and variable costs, then assume that for fixed costs we refer to total, and for variable costs we refer to unit. And the same is true for selling prices. If we just say selling price of sales, then assume that it is the unit selling price. Okay, but I try to be as particular as possible. Okay, so we have total fixed cost, unit variable cost, then unit contribution margin. Unit contribution margin is the unit selling price minus unit variable costs. And then the total operating income, or TOI, or occasionally we're going to just say operating income. Operating income means sales or sales revenue minus fixed cost minus variable cost is your operating income. See, we call it operating income because we don't include any financial expenses. We don't include any interest expense or expenses like of a non-manufacturing nature. Okay, of a non-manufacturing nature. So we have in mind, if you want to compare it with financial accounting, the operating income that we have here is the same as the operating income we call in financial accounting. In financial accounting, operating profit is sales minus cost of goods sold minus operating expenses, and those operating expenses are administrative expenses and selling expenses. So we cover those under our fixed costs here. Selling and distribution and admin in general, those two types of expenses that are used in financial accounting are represented by fixed costs here. But here we have fixed manufacturing costs as well. So not just administrative and selling and distribution and general, we include our fixed costs, include fixed manufacturing costs as well, or fixed manufacturing overhead. Okay, so no, it's not necessary to reconcile the two at this stage, but it is possible to. It's of course possible, and it has to be possible because knowledge cannot just change as we change topics, as we change chapters, isn't it? Knowledge has to have some stability. What you learn or what you teach must be stable at least for a semester, isn't it? I'm just joking. It has to be stable forever, or at least for a reasonable period of time, unless new knowledge um, dismisses it. All right. So we have these concepts, the whole list. Keep an eye and go back to the chapter and try to see what they are. All right. So this is the first one of the relevant concepts. And then we continue with these. We talk about relevant range, very important. In the Uber example, for example, your Uber cost is $13 only up to a certain number. If you want to bring in, say, 17 people and call in a 5-seat sedan, it's not going to be $13. You have to call more than one cars. Okay, so relevant range is important. And then unit selling price or selling price, USP, and then degree of operating leverage, the sensitivity between operating profit and sales. So degree of operating leverage tells us by what percent our profit changes, or EBIT, earnings before interest and taxes, or operating profit, by what percent our operating profit changes in response to changes in sales. Okay, we're increasing our sales by 2%, and our operating profit could increase by more than 2%. If we have fixed costs, then it should increase by more than 2%. So that is the degree of operating leverage, where you divide the percentage change in profit, operating profit that is, by percentage change in sales. We have a much simpler formula, but the economic concept of the degree of operating leverage is the percentage change in operating profit in response to a given percentage change in sales. All right, then the final two, one is margin of safety, and the final one is MS ratio, margin of safety ratio, margin of safety ratio. Then in addition to this, we're going to have concepts on concepts of bundle contribution margin, bundle contribution margin ratio, and also product mix. But they are not that different from what you already learned here. All right, so these are the relevant formulas to solve any problem. Okay, we're going to discuss one of the problems given the length of the video. If the video gets too long, then I'm going to stop after discussing the concepts, after presenting the concepts and formulas, and maybe have another video talking about one or two of the problems. And of course, I would like to do one of the select 15 problems. Okay, so let's look at the formulas. First one, and please, have them at your fingertips. You have to maybe memorize some of those, or if not memorize, write down in cards, and then carry with you to your classes or to your work. All right, the first one is contribution margin, which is sales minus variable costs. Sales minus variable costs. So in my wine example, I sell it for $10, I buy it for $7. My contribution margin is $3. Remember, contribution margin, sales minus variable costs. Now see, it's not these two words don't have any qualifier. You can qualify them by unit contribution margin. So you can call it UCM, what I did here. As soon as you qualify it by unit, then you have to add units to both of those. So if CM is sales minus variable costs, then UCM would be, unit contribution margin would be unit sales or unit selling price minus unit variable costs, isn't it? So that's what we have here. UCM is USP minus UVC. USP stands for unit selling price, and UVC stands for unit variable costs. And then the CMR or CM ratio. CMR stands for CM ratio, which is CM divided by sales. Now, the interesting thing about CMR is that it is a constant. If it is the same for 1 unit, for 10 units, and for 1,000,000 units. Why? Because it's a ratio, it's a relationship. Like for 1 bottle, my contribution margin was $3. But for 2 bottles, my contribution margin goes up to 6. And for the third, it goes up to 9. But look at my ratio, contribution margin ratio. It's true that I'm making $3 from every wine bottle I sell in America, importing from France. But if you look at the ratio, the relationship between that contribution margin to sales, then it is 0.3, because I make $3 for $10. So I'd be making $6 for $20. I'd be making $9 for $30. Yes, I'd be making more, but I would have to sell more as well on time. So contribution margin ratio is a volume neutral number. It is a relationship, and the relationship remains the same because we don't have any bulk discount or other forms of trade discount. So it is contribution margin by sales. It can be modified into unit contribution margin by unit sales, or total contribution margin by total sales, but it doesn't change. So I don't care. I'll just say CMR is the relationship between CM and sales. So CM by sales, or we've done it. Yeah. And then the break-even point, the princess of the chapter. Break-even point in units is total fixed costs by unit contribution margin. Total fixed costs. So let's say my total fixed cost was $1,000, and my only business is to import wine and sell it. So how many units, how many bottles do I have to sell every month to break even? The answer is found by dividing $1,000, because how much money I need to survive? How much money I need to get to that point of first sigh of relief? I need $1,000. That was my problem. My problem was $1,000. I needed to make $1,000 to live in America, to survive in America, to not borrow, to not get into debt in America, because my monthly expenses are $1,000. Fine. So I started my wine business. I've been importing it. I brought one bottle, sold it for $10. So I made $3. Then I brought two, made $6. Then I brought $100. Sorry, 100 bottles, and I made $300. Still not enough. Then I said, well, let's do 200 bottles if there is enough demand. So 200 bottles gave me $600. 300 bottles would give me $900. Then I started calculating. I'm getting close to $1,000. Then at one point, one of my friends calculated it. They said, well, you stupid, just divide $1,000 by 3. How much money you need? I said 1,000. Then how much you make from each bottle? I said $3. So he says, just divide 1,000 by $3, and you would get the number of bottles you would need to bring and sell to survive. So that's what we did. We divided our total fixed cost, which was $1,000, and we divided it by unit contribution margin of $3. You got it? All right. Now, unit contribution margin, again, to be more formal, is unit selling price minus unit variable costs. You've been told already. All right. So, and break-even point, that was break-even point in units. So I needed to sell 333.33 bottles. 333 bottles would give me $999. I may be fine. I'd just not pay my landlord $1 every month. So my rent is say $350. I'll just pay them $349 and ask for forgiveness for the last dollar. Or I would just bring one more bottle. So instead of 333.33, because bottles cannot be imported in fractions, so I would import 334 bottles and survive in America. All right. Then break-even point in dollars. Now, that was break-even point in units. Now break-even point in dollars. What is break-even point in dollars? The dollars means how much sales I have to achieve to make that $1,000. Now it's very easy. Once you know break-even point in units, you simply multiply it by your selling price. So we said, if we found that we would have to sell 333 or 334 bottles, so simply multiply it by $10, you'd get your break-even point in dollars. So that's a shortcut. But what if I don't have, or I don't know the break-even point in units? So can we calculate break-even point in dollars independently of anything? Yes, we can. So we use this. We divide total fixed cost, TFC, by CM ratio, CMR. CM ratio is my 3 by 10. $3 that I make from every bottle, $10 is what I sell it for. So 3 by 10 is 0.3. So if I divide $1,000 by 0.3, I get exactly how much? $3,333.33. And guess how many bottles? How many bottles I sell to make that revenue of 3,333? I sell exactly 333 bottles. Because 333.33 bottles times 10 would give me $3,333. Okay, so it's the same, just two sides of the same coin. Break-even point in units is the same as break-even point in dollars, but not same numbers. Break-even point in units gives you a quantity number. Break-even point in dollars gives you a dollar number. But it is easy. If you know one, you just multiply it by the selling price, and you know the other. So if you know the break-even point in dollars, just divide it by selling price, you'd get break-even point in units. So some students use the shortcut. They calculate this first and then multiply it by selling price, and they say, that's my break-even point in dollars. Or they calculate this and divide it by selling price, and then say, okay, that's my break-even point in units. But I would say good students would learn the two formulas independently of each other, because maybe the exam or there may be a quiz that requires you to do this. Then if you do that and then multiply it by $10, they would figure out that you don't know this formula independently. All right. Now, so these two are the key formulas: break-even point in units and break-even point in dollars. Okay. So let's take a pause and let's go back to our cell phone example. Let's say my trip costs me $1,000 and I make $250 of surplus of contribution margin from each phone I take to China. So how many phones would I have to take to make my trip cost neutral? The answer is divide $1,000 by your contribution margin. 1,000 is your cost, total fixed cost of the trip, $1,000, divided by unit selling price minus unit variable cost, or divided by unit contribution margin, which was $250 in our cell phone example. Why 250? Here it is. I have it here. So each one I sell in China for $1,000 and I buy in San Francisco for $750. So 1,000 minus 750 is my margin, $250 of contribution margin. It's called contribution margin because it contributes towards my fixed cost. It is contributing, isn't it? It is contributing towards my plane fare. Every cell phone that I have in my carry luggage is gonna pay for my airfare, plane fare. Okay, so each one means $250. Because as soon as I take it over to China, I can sell it to my friends and family, and ignoring any sales tax or any profit tax, I'd be legally, So also try to remember that our example doesn't include smuggling. We're not proposing a smuggling model. You just carry, say 3 or 4, or say the Chinese authorities allow you to carry up to 5 cell phones without paying any taxes. Because if you have to pay taxes, then that would take a bite of your contribution margin. Then our variable cost would go up because we're buying it for $750 and now we are assuming no other selling costs, no other miscellaneous costs like taxes or packaging or selling commission or agency commission or anything. So we simply go and sell it for $1,000. We buy it for $750. Our contribution margin is $250 per unit of this amazing gadget. So how many do I need to carry with me over to China? The answer is 4. $1,000 divided by $250. So that makes it 4. Isn't it a good way to visit your friends and family? Just carry something that you can sell overseas, and that fits in your hand luggage, and that doesn't involve any taxes or customs. All right, so we've seen those 2 initial formulas: break-even point in units and break-even point in dollars. Now, let's change our ambitions. Let's start dreaming. Let's start using those trips to make some more money. Okay, why just covering the trip? So on my first trip, I thought, okay, I need to take 4 phones, and the trip is going to be free. And next time I found some mozo in it. I said, well, why don't I take 5 and keep some money in my pocket? So I not only have a free trip, I actually make the trip profitable. Again, assuming no taxes and assuming that, you can carry, say, let's say 100 is the limit. 100 cell phones is the limit. That would not increase your fixed cost or variable cost. You can still buy them at $750 and carry them in your luggages without paying any extra airfare or taxes or facing any import or export restrictions. So if 1,000 is my relevant range, after which the fixed costs could go up, or you might need extra suitcases, or you might need to pay taxes or agency commissions or other forms of selling costs. So let's assume that our unit selling price still $1,000 and unit variable cost still going to be $750. So our contribution margin is $250. Now let's start thinking that how many units do I have to sell to make $1,000 profit on top of my $1,000 of trip cost? So how much profit you want to make? $1,000. What's your fixed cost? $1,000. So you need to cover your fixed cost and you need to make $1,000 of profit. So how much money you need in total? 1,000 plus 1,000. So you need $2,000. So simply divide $2,000 by unit contribution margin, or $2,000 by that $250. So that is our next formula, which shows the required sales. So here we have a target operating income. So Garrison's book, they call it target profit analysis. So they make a separate section, new section for target profit analysis. So under target profit analysis, they have these formulas. All right. So I call it required sales to make the target profit. So first formula is going to be required sales in units. And the next one is going to be required sales in dollars. Everything in units and in dollars. So all we have to do is superimpose the TOI on the TFC. So we have total fixed cost, and we would like to make some operating income. So that's also like a fixed cost. That's also given. My friend said, or my mother said, or my partner said that you have to, every time you go to China, I want you to come back with $1,000 of profit, or say $900 of profit. Okay, so whatever the target profit is, superimpose it on fixed costs. That's like another burden. Fixed cost is a burden, and now the expected profit is also a burden. So TFC plus TOI, TOI is target operating income divided by UCM. So the same old formula, just an extra burden, target operating income. All right. If you now divide the same numerator by CMR instead of UCM, CM ratio, you're going to get required sales in dollars. So this one's replication of the same. The only difference is the question was required sales in dollars. So I wanted to see, okay, how much total revenue I have to make to cover my fixed costs and also to make $1,000 of profit home, to bring $1,000 of profit home. So the answer is in CMR. So TFC, my original burden, plus my expectation burden divided by contribution margin ratio. And that contribution margin ratio for the cell phone example is going to be 0.25 because I make $250 from every sale of $1,000. So 250 by 1,000 is 0.25. In our wine example, which I like better, it is 0.3. I import wine for $7 and sell it for $10 in America. All right. So that would give you required sales in dollars. So that's the formula number 4. Now, this required, the TOI, this target operating income, is a good thing, but as I said, that your partner set an expectation of $1,000, but she didn't tell you, or he didn't tell you that there is tax, or she didn't tell you that I want $1,000 before or after tax. And you thought, okay, as long as I make $1,000, I'd be greeted well at home. I'd be celebrated at home. I'd be fine. I'll have a good homecoming. So you brought home $1,000, and she said, well, it's not exactly $1,000 because on this profit, we have to declare it's like a business activity. So any income is taxable in the US. So what if we have to pay 25% taxes on these extra income that you're making? Can you see? So now you made $1,000, but 25% is taken away by IRS. So your partner is not happy. She said, well, I thought you'd be making $1,000 from every trip, but now you're making only $750 from every trip. So you said, okay, let's find out. Let's work out, because there is no limit. The limit is 100 cell phones. So on my next trip, I could take some more. And assuming there is enough demand in China for your cell phones. So what do? You try to figure out, okay, how many? So it looks like I have to do some more. I have to have some more tricks. Yes, I can bring home $1,000 after tax. So we call it required sales on after-tax TOI. Required sales with an after-tax TOI. So the formulas before would give you required sales in units and in dollars before tax. That would be before tax. But if you want exactly $1,000 after tax, then modify your formula by this. So now required sales with an after-tax TOI. So again, we're going to have the answers in units as well as in dollars. So TFC remains unchanged. TFC is the original burden. Now TOI 1,000 is the expected operating income divided by 1 minus tax rate, 1 minus T. So your tax rate is 0.25. Now, if you divide $1,000 by 0.75, which is 1 minus T, is going to give you 0.75. So find out what happens. $1,000 divided by 0.75. So that means if you allow me a second, then I can calculate it for you. So $1,000 divided by 0.75 gives us $1,333. So that's the amount of money we needed to make, because of the 1333, let's see, if I multiply it by 0.25, see, it's exactly $333.33. So that's the amount of tax on the $1333. So I'd be making $1,333, but I'll have provision to pay taxes, assuming I receive no credit for any business-related expense or anything, which I'm sure if you report it as a business, that the IRS is going to give you some relevant allowance for any expenses, and you might even get your $1,000 deducted from the airfare if that is the sole purpose of your business, if you can justify it as a business expense. But that's a different debate. You have to enroll in my federal tax accounting 451 or 452 to learn those. Knowledge is expensive. There is no free lunch. Remember, the great American economist Friedman says it. He said it in a 1953 article. There is no free lunch. All right. So ignore it. If you want to learn about taxes, you are welcome to attend my tax classes, free of cost. But make sure that it is 1 or 2 sessions. You can't have dozens of sessions and not pay the university the tuition. All right. So $333 of taxes are paid off. So how much would be left for me or my partner? So remember, we had $1,000 divided by 0.75. That gave us 1,333. Now minus the 333.33. See, that leaves us with our exactly expected profit of $1,000. So everybody is happy, but that has increased my burden. My burden has gone up to add with $1,000 of TFC. I have to now add 1,333.33. How do I get 1,333.33? I divide by target operating income of $1,000. I divide it by 1 minus T. This process is called grossing up. To find the gross amount from a net amount, because the $1,000 expected target operating income, expected operating income was the net amount. The gross amount would be divided by 1 minus T. So after grossing up, we find the before tax TOI. So this would give you before tax TOI. So your TFC burden plus the expectation burden, the profit expectation burden, divided by UCM and CMR to get the answer in units and dollars. See, identical. Divided by UCM, you get the answer in units. Divided by CMR, you get the answer in dollars. So we have learned 6 things so far. Break-even point in units, break-even point in dollars. Then required sales in units before tax, required sales in units, required sales in units and required sales in dollars. Those 2 before tax. And now required sales in units and dollars after tax. Required sales in units for TOI after tax, and required sales in dollars for TOI after tax. All right, so we have those important formulas. Now we are closing in. Our next formula is about the degree of operating leverage. As I said, degree of operating leverage is the response, is the profit response to changes in sales. If sales go up by 1%, we expect our profits to go up by more than 1%. Otherwise, what is the incentive? And if life is so boring that you do an extra hour and you get $8 more and you keep doing. Remember, in America, we have overtime. So they call it overtime, and overtime pay is usually higher than your normal pay. Why? Because overtime is overtime. No one wants to work more than 40 hours or more than a certain amount of hours. So if you want to allure them, if they have to break away from their family or from their other holiday plans, you have to allure them. You have to compensate them well for that. So that is important, that our profit goes up by a higher percentage than the increase in sales. And that happens because of some leverage effect. By leverage effect, we mean fixed costs. So have some fixed costs. If all your costs are variable, remember, if your fixed costs are 0, then you will be in that boring state. Your sales go up by 100%, your profit goes up by just 100%. your sales drop by 100%, your profit also drops by 100%. So your DOL is going to be 1.00. When the company has no fixed costs. If all costs are variable, then when sales grow by 10%, operating income also grows by 10%. All right, so see, this formula is very smart because it doesn't have those fixed costs or variable costs. It says simply contribution margin divided by NOI. I mean, this is an amazing formula that the finance textbooks don't use, because degree of operating leverage, and degree of financial leverage, this DOL and DFL, these are primarily finance concepts. These are taught in finance. Whole chapters on operating leverage or financial leverage, because we want to see how our profit responses to changes in volume, changes in activity. All right. But the reason I call it smart is that it just says divide your contribution margin by net operating income. But remember, this is not unit contribution margin. This is contribution margin at the level of sales that you already have. Well, it would be unit contribution margin if you are only selling one unit. If your current state is that you are selling your current volume of activity, your current activity level or capacity, utilization level is just one unit, then it would be unit contribution margin. But if it is say 10,000 units or any given volume, let's say we have 8,000 students now, and we are trying to find out our degree of operating leverage. It means the president or the vice president finance wanted to know that, Professor Karim, tell us by what percentage our surplus, our operating surplus, would drop or increase with changes in student numbers. If we, what if we drop our students, drop our enrollment by 3%, we lose 3% enrollment, or what if we gain it by 7%? So if we have, because the university has so many fixed costs, I'm sure the degree of operating leverage is more than one. It is maybe more than two or even more than three, depends on the volume of fixed costs. So I would say, having done the calculations, I would say yes, our surplus is going to grow by say 17% with 7% increase in student numbers. That means we have a lot of fixed costs. But this is easier. I need to find out contribution margin at the current 8,000 student number level. So right now we have 8,000 students. We have a contribution margin. I can calculate my contribution margin. My revenue from 8,000 students minus variable costs for 8,000 students. So that is my contribution margin at the current level. And then I divide it by current net operating income. If right now my current net operating income is say $2 million, or operating surplus is $2 million, and if my current contribution margin is $8 million, that means our operating leverage is 4. Contribution margin is $8 million, operating surplus is $2 million. That means we are having a 4.0 operating leverage. That means every 1% increase in student numbers, our operating surplus is going to grow by 4%. 4%. All right. So that's our degree of operating leverage. Contribution margin at your current level divided by net operating income also at current level. Remember one thing, that you'd hope that net operating income is not zero. Because if it is zero, what would happen? If it is zero, your degree of operating leverage is going to be infinity. Of course, it would be infinity if we are now having a surplus of zero. Everybody should, they would go, go bizarre in excitement if we have even $1 of surplus. Because from zero, $1 is how many percent more? It's infinity percent more from zero. Because zeros, every percent is zero. Zeros, 100% is also zero. Zero is 50%. What is 50% of a zero? Zero, isn't it? So if I say right now our operating surplus is $0, and that $0 is going to increase by 50%, that means it would still be zero. Therefore, you'd hope that this net operating income level is not at zero at the point that they ask you that question. And net operating income of zero means you are at break-even point, isn't it? That means you are at break-even point. So it is possible. Net operating income of zero doesn't mean that you are doing too poorly. You are at break-even point. So from break-even point, any increase is like infinity in terms of percentage. But from a positive number, increases make more sense. And increases don't make much sense from negative numbers. There's another problem with increases. Let's say our current operating surplus is negative $2 million. Now, what is 10% more of that? 10% more, if that increases by 10%, that would mean a bigger negative, isn't it? That would mean a bigger negative. So it needs to drop by a certain percent. So that's possible. Then if we have more students, like 4% more students, then our operating surplus is going to drop by this percent. You would calculate it that way. So contribution margin by net operating income. And that's why this formula, albeit very smart, but it is limited. It is limited because what if your numerator is positive, but denominator is negative? Then you'd have a negative answer, isn't it? Say our contribution margin is 8 million, but our net operating income is negative $2 million. Then we'd have 8 million by minus 2 is going to be minus 4. So it is going to be that with every 1% increase in our student numbers, our operating surplus is going to drop by 4%, which would make everybody go wild. They say, well, what do you mean? Our student numbers go up by 1%, and you're saying that our operating surplus is going to drop by 4%. So what's the point in having more students then? But you have to tell them that, calm down, guys. I said your operating surplus is going to drop by 4%. What is your operating surplus now? Your current operating surplus is a negative number. It's negative $2 million. So if that drops by 4%, isn't it a good news? It means you would have a smaller negative. A smaller negative is like having a positive, isn't it? All right. So we can work it unless the number denominator is 0. If the denominator is 0, DOL is going to be infinity. All right. I gave the finance definition of DOL: percentage change in operating income from a given percentage change in sales. That's called degree of operating leverage. And what is degree of financial leverage? That's not used in CVP, but a related concept. DFL, degree of financial leverage, is percentage change in net income, not operating income. That's percentage change in net income with a given percentage change in operating income, or EBIT. So that's what we call EBIT EPS relationship, EBIT EPS relationship. Because if sales grow, then our EBIT grows. Means if sales grow, then our operating profit grows. But if operating profit grows, then our earnings per share or net income also grows. So the relationship between EBIT and EPS is examined by DFL, degree of financial leverage. And the relationship between sales and operating profit, or sales and EBIT, is examined by operating leverage. EBIT EPS is financial leverage. Sales EBIT is operating leverage. All right. So if you, I don't need you to be confused. Just narrow it down to, or limit it to our operating leverage formula. Degree of operating leverage is going to be a multiple like 2, 1.5, 1.6. It means if you have 1.6, that means for every 1% change in sales, your surplus is going to change by 1.6%. And an amazing thing about DOL and DFL is that it works both ways. So if student numbers go up by 1%, let's say our operating surplus goes up by 4%. And if student numbers drop by 1%, then operating surplus will drop by 4%. So operating leverage, or fixed costs, is a double-edged sword. It helps you at good times, but it drowns you at bad times. That's why it is risky. Warren Buffett would recommend you against having fixed costs. That's why so many, in the US, interest rates are traditionally, and right now is very low. Still, the wisest companies, the wisest entrepreneurs would recommend you not to borrow. They say, don't keep your fixed costs, because if you're leveraged, then at bad times, you'd be in big trouble. All right. So there's our DOL formula. And the final page of formulas is here. Well, not the final page. We have one more to go. So this one is about margin of safety, which is one of the easiest. Margin of safety means, when you drive, you know that you don't drive to the shoulder. So between your car and to the next car, there's some room. Or between your car and the divider, there is some room. That is the margin of safety. So margin of safety is sales minus break-even sales. Let's say currently I'm making $1,000 and my break-even point is also $1,000. Then I have no margin of safety, isn't it? I'm floating, I'm still breathing, but I have no margin of safety. I don't know if my income drops by $10, then I'd be technically bankrupt. But if I'm currently making $1,300 while my fixed costs are $1,000, then I have some margin of safety, don't I? I do. Because I can afford to lose some income. I can afford to lose some hours without getting to my bone. So I'd not be sitting on my bone. I'd have some cushion there. So that cushion is called margin of safety. Sales minus break-even sales. And margin of safety ratio or margin of safety percentage is this margin of safety divided by sales. So for sales minus break-even sales, let's say, my $1,300 example. So if my sales are $1,300 and my break-even sales is say $1,000, then I have some room. My sales could drop by what? 300 by 1,300 would be about 7 to 8%. So my sales could drop by 7-8% without getting me drowned. All right. So those are the two important margin of safety ratios. There is margin of safety analysis in the chapter, in the textbook. And my final, before we get into product mix, I was so excited thinking that this is the final formula, but it is not, unfortunately. But this is an amazing formula. It talks about strategies, which is an important part of the chapter. What we do here is that the formula looks like it is called a point of indifference. But what is the point of indifference between which two? What happens? Let's say we have two business plans, two possible strategies. Under one strategy, we can invest in high-tech, capital-intensive machines, or we can make our business very, very capital-intensive. So everything mechanized. We invest heavily in equipment and in modern processes, but have less variable costs. So our fixed costs are going to go up by a lot because equipment and all those automation is expensive. So you invest heavily in fixed costs in order to minimize your variable cost. Or you could keep your fixed costs to a minimum and defray a lot of variable costs. Let's say I needed 3 cranes. So I bought one and I leased the other 2. So assuming leasing by the hour, or leasing by activity level. So I had a flexible lease whereby if I don't need it, I can not lease it. So the days I need all three cranes, I still have 3. But I bought one and then I leased the other 2. And then the days that I don't need 3 cranes, those days I'm still safe. I don't have any idle capacity. I have my one, and if I need a second one, I can lease the second one, and I don't need a third one, I don't lease it. I don't lease the third one. So that's a different, sometimes less risky business model. So let's say we have 2 propositions here, 2 plans. One is capital intensive, another is labor intensive. The capital intensive one has more in fixed cost and less in variable cost, but the labor intensive one has less fixed cost but more in variable cost. And let's say our selling price is the same. So selling price is the same. That means under one plan, my contribution margin is going to be more, while my variable cost is less. Can you see? In my capital intensive plan, where I have more investment in machines and equipment and automation, I will have, say I'm selling everything at $15 and my variable cost is only $5. So I have $10 of contribution margin. In the other plan, where I didn't invest a lot in equipment and automation, so I rely a lot on variable costs. So I spent less on fixed costs, but I'm still selling at $15 each, but my variable cost is say $9. So I'm making a contribution margin of $6. Remember the previous one, it was $10. So which plan is better? What should I do? Because if I invest in heavy equipment, then I'm stuck. These costs could be sunk costs. There's no action that could revert it. Remember sunk cost? In one of the earlier videos. So you're the management accountant. They wanted you to answer which one we do. You said, well, I can't tell you which one you do. What kind of scenarios you anticipate? If you're anticipating a growth or a definite growth in demand, definite growth in future, if you're anticipating growth, then go for one. For growth, I would say you go for the capital intensive model, because your fixed costs are going to be covered somehow, because you are going to see high sales. So you'll not have problems with sales. You sell more, your volume is going to be more. So you can afford to invest more in capital intensive machinery. So that means you're selling at $15, your variable cost will be kept to the minimum, because all costs have been automated. All costs have been taken care of by fixed costs or fixed investments. All right. So you'll have more contribution margin under the capital intensive plan and less contribution margin under the labor intensive plan. So it all depends on what they anticipate the future to hold. And of course, no one can tell the future with 100% certainty, but if you have more scenarios that show better signs, that show that are more growth intensive, or that are more like growth, then you go for the capital intensive plan. If you have bleak, or if you have some grim scenarios, if you anticipate drop in sales or anticipate a recession, then hold off your capital investments. For the time being, rent, don't buy. Remember, rent versus buy analysis. If you think that your job is going to be permanent, you and your partner, you both are going to be working, and you both would be working in the same place and close to your home, then buy. But if you are unemployed, if you are just looking for jobs, or if you're not sure whether you live in the state or you live in the town, then rent. All right. So we don't get into all this storytelling. This is a recurring formula. This is Karim formula. You will not find it anywhere. And the Karim formula is that we calculate a point of indifference. Means I'm going to be able to tell you the number of units that will make the choice indifferent. And then above that unit, if you anticipate sales to exceed that unit, then go for the capital intensive plan, go for high fixed cost plan. And if you anticipate lower units in future volume and future demand, then go for the labor intensive plan. So the easiest way to calculate the point of indifference is FC1 minus FC2, means fixed cost under plan 1 minus fixed cost under plan 2. And you're going to like it even more when you know that it doesn't matter whether FC1 is the capital intensive one. So the answer, the numerator doesn't have to be positive. If the numerator is positive, then definitely the denominator is going to be positive too. So you'll not have a negative answer. So FC1 minus FC2 divided by CM1 minus CM2. Okay, that would give you the answer, and that answer will be a number. That means at that number, the two methods, the two plans are going to be indifferent. They will result in the same profit, or there's profit or loss. If they end up in, if the number is a loss one, then you will be losing the same amount of money at that activity level. Then at a higher activity level than that, your capital intensive plan or higher fixed cost plan is going to be better, will be less losing if you're already at a loss, or will be more profitable if you're already at a profit. So FC1 minus FC2 divided by CM1 minus CM2. So this point of indifference can be calculated in terms of dollars as well. You can do it in terms of dollars as well. All you have to do is FC1 minus FC2 divided by CMR1 minus CMR2. So that's Karim formula alternative. FC1 minus FC2 in dollars, but divided by CMR1 by CMR2. That will give you the point of indifference in terms of dollars. That's called strategy comparison, strategy analysis, also in the chapter, in chapter 5. So these are all, everything that I said tonight, are relevant to your chapter, to your topics. Of course, if we go beyond, beyond one textbook, beyond Garrison, then there are many other concepts that could be embraced. But for now, I'd like to keep my discussions confined to the textbook that we use. All right. Now, a couple of final formulas. And this one is about product mix. That's also an important domain of the CVP analysis. Product mix means so far we had a single product in our mind. But how many businesses trade on a single product? Most businesses have diversified products. Even television channels like CNN has headline news, HLN. So newspaper companies, they produce weekly products. They produce, and they have television channels. So most businesses nowadays have a multiple of products. McDonald's sells hamburgers. They sell Big Mac. They sell double cheeseburger. They sell McChicken. They sell so many other things, ice cream, chicken nuggets. Mouth-watering, some of those. But and also, of course, coffee and beverages. So what do we do here in case of product mix? We need to know how many units you have to sell of each one of those in the product mix. Each one, let's say you have A, B, C, you have breakfast, lunch, and dinner at a restaurant. So the manager wants to know how many breakfast customers I need to have and how many lunches I need to sell and how many dinners I have to sell to break even, because I sell all three. Then you need to find out their selling prices of each one of those. Okay, tell me how much you sell every breakfast on average, how much you sell every lunch on average, and how much the average price of a dinner. Average would be fine because there is no set dinner price. Dinner prices vary by the menu. But let's say we find an average. So average selling prices of your three products, breakfast, lunch, and dinner, then average variable costs of each one of those. And that would give us the average contribution margins. And an extra piece of information I need beyond selling price and variable costs, I would need to know the mix, the ratio in which you sell your breakfast, lunch, or dinner. It could be 1-1-1, it could be 2-1-3, it could be 3-1. So get us the ratio. Once you have the ratio, then the formula becomes simple. Break-even point in units is equal to still TFC, no change, total fixed cost, but divided by, instead of contribution margin, I call it bundle contribution margin or weighted contribution margin, WCM. Bundle CM or WCM. So, or TFC divided by WCM. Here, TFC divided by WCMR. All right. So it's a bit cluttered now. Break-even point in units would be total fixed cost divided by bundle contribution margin. I'll show you how we calculate bundle or weighted contribution margin. And then the break-even point in dollars is going to be total fixed cost, same, divided by bundle contribution margin ratio. So the ratio here. So bundle or weighted contribution margin ratio. All right. So let's now calculate or see the calculation of bundle contribution margin and bundle contribution margin ratio. So I have two products here, A and B. I have their selling prices, their variable costs, and their unit contribution margins. But look at my last column. The last column is the mix, 3:2. That means if I sell 3 units of A, I sell 2 units of B. If I sell 30 units of A, I sell 20 units of B. So bundle contribution margin is simply the individual contribution margins multiplied by their weight, multiplied by the weight. So individual contribution margin here is $8, you can see, for A, and their weight is 3. So multiply 8 by 3, 8 times 3 is 24, and add it to 14 times 2. 14 is the contribution margin from the product B. See, selling price of $30, variable cost of $16. So leaves a contribution of $14, and 14 times 2 gives you 28. So 3 8s are 24 plus 14 2s are, or 2 14s are 28. So 24 plus 28 gives you the bundle contribution margin. And the bundle contribution margin we have is going to be 52, 24 plus 28. So that's your bundle contribution margin once you have the fixed cost, which is missing here because I didn't plan a whole problem. So if you now divide the total fixed cost by that $52, you're going to have the break-even point in units. That break-even point is going to be a bundle. Like if the answer is say 113, that would mean 113 bundles. Then you have to unbundle it. So in every bundle, there are 3 A's and 2 B's. So 113 bundles mean 113 times 3 A's and 113 times 2 B's. You see my point? The break-even point is going to be a number, but it is not going to be individual units. It would be individual bundles. Let's say an Apple store, if they say that if we sell 1 cell phone, then you sell 2 iMacs or two iPods or 3 iPads. So if that's the ratio, then the store has a fixed cost, and for each individual units, like from the cell phone, from an iPad, from an iPod, from an iMac, let's say these are the 4 products. So they make some contributions from each one of those, but there is a ratio, like 1 for 4 or 1 for 5 and 1, 2, 3, 4, whatever ratio they sell it. So if your answer is 115, that means, and if the ratio is 1, 2, 3, 4, that means 115 cell phones. Then if say the ratio, say the 4 products are cell phones, iPads, iPods, and iMac. Remember, cell phones, iPods, iPads, and iMac. So if and the ratio is 1, 2, 3, 4, and the answer is 115. So 115 cell phones, and then twice as many iPods, and then 3 times as many iPads, and 4 times as many iMacs. That will be the final answer. Anyway, so that's what it's going to be. Final answer. So nevertheless, the answer is going to be simple. Total fixed cost divided by bundle or weighted contribution margin. And then if you want the answer in dollars, then it would be total fixed cost divided by bundle contribution margin ratio. Bundle contribution margin ratio is bundle contribution margin divided by bundle sales. So in our case, it would be $52 divided by what is our bundle sales? 3 times, see how much we sell. Each one of A is $20. So 3 times 20 is 60, and 2 times 30 is also 60. 3 times 20 is 60, 2 times 30 is 60. So 60 plus 60 is $120. So $52 divided by $120. That would be our CM ratio. So let me show you. 52 divided by 120. So our CM ratio is going to be 0.43. That would give us the answer in dollars. Okay. So we have product mix, and we have the 2 answers: break-even point in dollars as well as break-even point in units. Now the final slide. We are near the close of it. This is the application. So what we have learned so far? What we have seen? We have seen that break-even point or CVP relationships can be used as an amazing tool. It offers you so many tools to plan your future, to make forecasts, to find out how many units you have to sell to survive, to find out how many units you need to sell to make a certain amount of profit. If you have plans, like sometimes even students, who work part-time, sometimes they have plans. They say, well, this month or after 3 months, I want to make this trip to, say, Hawaii, or I want to go to Jamaica, I want to go to London or New York or France, and I need, say, an extra $2,000. I need to save $2,000. How many extra hours do I need to work? You have to find out your fixed cost divided by your contribution margins, how much money you make for every hour, minus what's your variable costs. So if you are in any business, you can plan for the future using break-even points. Remember, in CVP analysis, our central one is the break-even point, but that's not just what you calculate. And a knowledge about break-even point is important, because that's where your guard is. Like in cricket, we used to hear many of these commentators. They say that good batsmen, if you follow cricket, a good batsman knows where the off stump is, because your eyes are fixed on the bowler. You're focusing on the bowler. Your off stump is behind you, but you got to know where it is, so that you know which balls to leave and which balls to play and which balls to strike and which balls to play out of the park for a 6. You see my point? So that my off stump is my break-even point. That's my fixed costs. Those are my commitments. Those are committed fixed costs or committed costs. I have to somehow manage enough money to pay those. Otherwise, I would be technically bankrupt. Or in the long run, a better way to look at it is to minimize those fixed costs. That's why I'm a big proponent of killing your overheads. Rein in on your overheads. You have to have it under control, because those are the ones that are going to drown you. It's not your variable costs. Variable costs, you can just switch off. But fixed costs cannot be switched off. Like when you're traveling, your fixed costs are still there. If you have an auto loan, if you have student loan, if you have home loan, you have credit card loans, what do you do? Now you're overseas, you're visiting and you are living free. Say you are at your sister's, they're offering you free accommodation, free food, free transport, everything. Still, your anxiety is about your fixed costs back home. So fixed costs can kill you. All right. Anyway, so we can plan about those fixed costs and how to take care of those, and we can also plan about our extra profits that we need to make, or if we have capital investment plans, let's say for next 2-3 years, we need to have some operating surplus so that we can build a reserve to pay for our expansions. So by what percent we need to grow to achieve that level, that extra savings level. So these are some of the applications that I could think off my head. One is planning and forecasting. Second is sensitivity analysis. when you solve problems, you'll see most of your problems are going to have that. Sensitivity analysis means they would give you a scenario, a set scenario that say, yeah, your fixed cost is $10,000 a month, your unit selling price is $15, your variable cost is $10. So calculate your break-even point in dollars and in units. But then they will say, okay, what if? Now they will bring a series of what if questions. That, okay, now go back to the original data and assume your new fixed cost is going to be 20% more than original, than last month's. So now you have $1,200 in fixed cost, not 1,000. So all calculations change, and they'll say, what if my variable costs go up by 10%? Or what if one of the variable costs, which is gas, say gas prices go up by 30%, which accounts for, say, 20% of my variable costs. So 20% is going increasing by 30%. So if your total variable cost is $8, first calculate 20% of that $8, which would be $1.60, and then increase it by 30%, means multiply $1.60 by 1.3. So that would give you a new number, and increase that, find out how much it has gone up by, and add it to your $8. So you have a new variable cost. As soon as any one in the mix changes, all your answers are going to change. You see, because they're all very interlocked. So if my fixed costs change, then the answers will change. If my selling prices do, answers will change. If my variable costs do, answers will change. So that's called sensitivity analysis. What if we have to spend more money on advertising, and what if we slash our sales force by 50%, and give it to some agencies and pay them variable commission, so you have less fixed costs but more variable costs, that, like those strategy problems or strategy comparisons. So there will be a whole host of things that come under sensitivity analysis. Then you have scenario analysis, which is more or less the same, that what if sales are 10,000 units or 15,000 units or 20,000 units. We don't know what our actual sales are going to be, but the manager or the owners wanted to know what the different profit figures are, they so that they can plan better, or they can they can, or they could have, say, bleak scenarios, that what if currently we're doing at 100%, what if it would drop to 80% capacity or 60% capacity or 50% capacity? Tell me how bad it's going to look like, because it's always better to know about a future uncertainty, about a bad situation, than actually learning it when it's all happening. Like weather forecasts. We know that we can't prevent a hurricane, but we like to give everybody the forecasts so that they can take precautionary actions. Then finding out or figuring out that there is a hurricane going on when it is actually going on. All right, so scenario analysis. Then we can plan an appropriate cost structure, like my FC1, FC2, or my labor intensive versus capital intensive plans, so that we can compare and choose one or the other of the two cost structures, or one from three. Then preparing for, of course, when you have three, then my FC1 minus FC2 won't work. I need to tell you. Then preparing for turbulent times. It teaches us coping strategy as to what happens, what are you going to do if things turn out to be bad, turn out to be worse. All right, so that's all we have, and I hope you enjoyed it. Remember, break-even point is fun. Total fixed cost divided by unit contribution margin, or total fixed cost divided by unit contribution margin ratio, or just CMR. Because unit contribution margin, UCMR and CMR are the same. CM ratio doesn't change no matter whether you calculate it on a per unit basis or you calculate it for the whole. Now, before I go, I'd like to remind you one important thing. One important thing about this whole CVP analysis is that remember what is your unit. You have to find out what your unit is. Okay, if unit is like a passenger, when you're planning about flights, let's say I'm thinking of a flight and trying to find out how many passengers I need to have that flight viable. So flight costs, like the landing fees, the aircraft depreciation, the pilot's salary, and my crewmen and crew people, crewmen and women, my air crew, their salaries and all those benefits, say these are fixed. And then variable cost would be even jet fuel. The fuel cost would be fixed. The variable cost would be maybe beverage. In that case, my unit is passengers. So they're asking you questions about how many passengers they need to have a break-even flight. But if we change it, and if a flight becomes a unit, if the whole airline becomes a whole business, and then they say, okay, how many flights I need to break even as an airline? Remember, breaking even on a flight or on a flight-by-flight basis and having break-even flights, break-even flights, break-even flights, so profitable flights, profitable flights, profitable flights, is different from having breaking even as an airline. Because airline doesn't think of individual passengers. Well, I mean, you could do it for at a passenger level, that how many passengers they need to carry to break even. Then you would have to have an average passenger price, average passenger variable cost, and fixed cost of the whole airline, which would include all those aircrafts, their fixed costs, all the pilot salaries, everything together. That's possible. So it's important for us to know my unit. So the definition of the unit and the definition of the business, because fixed cost would be for the business and variable cost would be for the unit. Remember, fixed cost would be for the business, for the activity, for the total activity, for the operations. And variable cost and unit selling price would be for the units. So a definition of your unit and a definition of the business is important. Without it, none of the formulas would work. All right. So this is fun, and I had fun. I hope you had fun too. And on the next video, we're going to solve 1 or 2 problems from chapter 5. But I hope you start working on the problems based on the ebook. You have the books, you have the assignments, you know the quizzes. So please start solving them and ask me questions if you have. I'm sure you'll be fine, but I'm also here for you. All right. Thank you. Have a good night.